There is a mistake quietly affecting millions of retirees across America right now. It does not involve stocks, it does not involve cryptocurrency, and it does not require a market crash to cause damage. In fact, the money involved is often sitting in what many people consider the safest place possible: their checking account or their savings account. For decades, financial advice was simple: pay off debt, build savings, keep cash available for emergencies. And for retirees, that advice still matters. But there is a problem. The tax code, Social Security system, and Medicare premium structure do not view cash the same way most retirees do. They view cash based on the income it produces, and once that income crosses certain thresholds, the consequences can begin appearing in places most people never expect. A larger federal tax bill, a higher percentage of Social Security benefits becoming taxable, or increased Medicare premiums years later. The surprising part is that many retirees never realize the connection. When a bank advertises a high-yield savings account paying 4 or 5% interest, the focus is always on what you earn. Almost nobody discusses what that additional income might trigger elsewhere. And that omission matters. Because retirement is different from the accumulation years. When people are working, additional income is usually welcome. But retirement operates under a different set of rules. A retiree may already receive Social Security benefits. They may receive pension income. They may take withdrawals from an IRA. They may collect dividends from investments. Every new source of income enters a system of thresholds, formulas, and calculations that determine how much ultimately stays in their pocket. This is where many retirees encounter a problem they never saw coming. Not because they made a reckless investment, not because they took excessive risk, but because they believed more interest automatically meant more money. Sometimes it does, sometimes it doesn't. And sometimes the net benefit is far smaller than expected. The reference case that inspired today's discussion involved a retired pharmacist who moved a large cash balance into a high-yield savings account after receiving a promotional offer from her bank. The additional interest increased her taxable income and changed how much of her Social Security benefits were subject to taxation. The account itself was not the problem. The problem was understanding how the account interacted with the rest of her retirement income. That distinction is critical, because this is not a story about avoiding savings accounts. It is a story about understanding thresholds. Tonight, we are going to examine 3 financial traps that can affect retirees with large cash balances. First, how interest income can increase the taxation of Social Security benefits. Second, how rising income can influence future Medicare costs. And third, why many retirees focus on account balances while completely overlooking the tax mechanics operating underneath them. Most importantly, we are going to answer the question that every retiree should ask: how much cash should actually remain in checking and savings accounts before the money stops working efficiently? The answer is not the same for everyone, but by the end of this analysis, you will understand exactly how to find your own number. To understand why a large checking or savings balance can create unexpected consequences in retirement, we need to understand one concept that appears repeatedly throughout the federal tax code: income thresholds. The government does not simply look at how much money sits in a bank account. It looks at the income that account produces. And for retirees, that distinction can be extremely important. Let us begin with Social Security. One of the most common misconceptions in retirement planning is that Social Security benefits are either fully taxable or completely tax-free. Neither statement is correct. The IRS uses a calculation known as provisional income to determine how much of a retiree's Social Security benefit may become subject to federal taxation. The formula generally includes adjusted gross income, certain tax-exempt interest income, and 1/2 of annual Social Security benefits. This is where savings account interest enters the picture. Every dollar of taxable interest generated by a checking account, money market account, certificate of deposit, or high-yield savings account increases taxable income. And as that income rises, more of a retiree's Social Security benefit can become taxable. The important point is this: the retiree is not being taxed twice. This is a common misunderstanding. Instead, the additional interest income increases the percentage of Social Security benefits that become subject to taxation under existing IRS rules. For some households, the effect is minor. For others, particularly those already close to an income threshold, the impact can be surprisingly large. The second layer involves Medicare, specifically Medicare's income-related monthly adjustment amount, commonly known as IRMAA. Many retirees are unaware that Medicare premiums are not always the same for everyone. Higher-income retirees may pay additional surcharges on Medicare Part B and Part D premiums. Even more surprising is the timing. Medicare often relies on tax return information from prior years when calculating current premiums. That means a financial decision made today may not fully reveal its Medicare consequences until years later. This does not mean retirees should avoid earning interest. Far from it. The goal is not to eliminate income. The goal is to understand how that income interacts with the broader retirement system. A retiree earning an additional $5,000 of interest may still come out ahead. The problem occurs when nobody calculates the net effect. The bank advertises the gross return. The retiree experiences the after-tax result. Those are not always the same number. Now let us discuss something that generates enormous confusion every year. The idea that there is a government-approved amount of money retirees are allowed to keep in checking. There is not. No IRS regulation says a retiree can only keep a specific amount in a bank account. No federal rule establishes a universal checking account limit. That claim is simply incorrect. What does exist are income thresholds, and once interest income pushes a retiree across those thresholds, the financial outcome changes. This distinction is critical because the optimal amount of cash varies dramatically from household to household. A retiree living primarily on Social Security may have a completely different threshold than a retiree receiving pension income, dividend income, rental income, and required minimum distributions from retirement accounts. The number is personal, not universal. The third area of confusion involves bank reporting requirements. Many retirees have heard about the $10,000 reporting threshold and immediately assume they have done something wrong if a bank files a report. That is not true. Under federal law, banks generally file a currency transaction report for certain cash transactions exceeding $10,000. This is a regulatory reporting requirement, not evidence of wrongdoing. Most retirees will never encounter a problem related to these reports. The issue arises only when individuals deliberately attempt to structure transactions to avoid reporting requirements. The lesson is simple. Never make financial decisions based on internet rumors about reporting thresholds. Conduct transactions according to legitimate financial needs and maintain proper records. That approach eliminates most of the risk. When we step back and look at all three systems together, Social Security taxation, Medicare surcharges, and banking regulations, a clear pattern emerges. The government is not penalizing retirees for saving money. The government is measuring income. And retirement planning increasingly becomes a question of managing how income appears on a tax return. This is why two retirees with identical account balances can experience completely different outcomes. One may face no additional taxes. The other may trigger additional Social Security taxation, move closer to Medicare surcharge territory, and reduce the efficiency of their retirement income strategy. The difference is not the balance. The difference is the interaction between that balance and the rest of the retiree's financial picture. And that brings us to the most important question. How much can these seemingly small changes actually cost over time? Because once the numbers are examined carefully, the financial impact becomes impossible to ignore. At this point, the natural question becomes, how much money are we actually talking about? Is this a minor bookkeeping issue? Or can it genuinely affect a retiree's financial security? The answer depends entirely on the numbers. Let us look at a realistic example. Imagine a retired couple receiving $38,000 annually from Social Security. They also receive $22,000 from a pension and another $8,000 from investment dividends. Their total income picture is relatively common among middle-class retirees. Now suppose they maintain $250,000 in savings and money market accounts earning approximately 4.5%. That generates roughly $11,250 in annual interest income. At first glance, earning an additional $11,250 sounds like a victory. And in many respects, it is. But retirement planning requires looking beyond the headline number. That interest income becomes part of the household's tax picture. It may increase the amount of Social Security subject to taxation. It may increase adjusted gross income, and it may reduce the margin of safety between current income levels and future Medicare surcharge thresholds. The result is that the household does not keep the full $11,250. Some portion is lost to federal taxes. Some may be lost to state taxes. And some may create secondary effects elsewhere in the retirement system. The important lesson is not that the interest was a mistake. The lesson is that gross income and net income are two different things. Retirees must understand both. Now consider another scenario. A widow age 74 receives $24,000 in Social Security benefits, $15,000 in pension income, and $18,000 in annual IRA withdrawals. Her income is stable, her expenses are manageable. She also maintains a large emergency reserve accumulated over decades of careful saving. Because she has always viewed cash as completely safe, she never evaluates how the interest generated by those savings interacts with the rest of her retirement income. Each year, additional interest slowly increases her taxable income. No single year creates a disaster. No single year creates a crisis. But over a decade, the cumulative effect can amount to thousands of dollars. This is how many retirement mistakes occur, not through one catastrophic event, but through small inefficiencies repeated year after year. The reference case that inspired this discussion attempted to calculate a specific balance threshold where additional savings interest became less efficient due to taxation and income interactions. While the exact number varies dramatically by household, the underlying principle is valid. Once income approaches important thresholds, every additional dollar deserves closer examination. So what should retirees actually do? First, determine total annual non-Social Security income. That includes pensions, dividends, IRA withdrawals, rental income, and interest. Second, calculate how much interest current savings are producing each year. Many retirees know their account balance. Far fewer know the exact amount of annual interest being reported to the IRS. Third, review whether current income levels place the household near important thresholds involving Social Security taxation or Medicare premiums. Fourth, evaluate whether cash reserves are larger than necessary. This does not mean eliminating emergency savings. Quite the opposite. Emergency reserves remain essential. But many retirees accumulated cash balances during working years without revisiting the purpose of those funds after retirement began. Money that must remain liquid belongs in cash. Money intended for future income planning may deserve a more comprehensive review. The objective is not to maximize returns. The objective is to maximize after-tax retirement income. Those are not always the same thing, and that distinction may be the most important lesson in today's discussion. The banking industry measures balances. The IRS measures income. Medicare measures income. Retirement planning measures outcomes. And outcomes are determined not by how much money sits in an account, but by how efficiently that money supports the retiree's overall financial plan. Before making any changes, gather 3 documents: your most recent tax return, your latest Social Security statement, and your year-end bank interest statement. Those 3 documents contain nearly everything needed to begin evaluating whether your current cash strategy is helping or quietly working against you. Because the real danger is not keeping too much money in checking. The real danger is assuming that a financial decision is harmless simply because it appears safe. In retirement, every source of income interacts with every other source. And the retirees who understand those interactions are often the ones who keep more of what they spent a lifetime earning. Thank you for watching. Stay informed. Stay disciplined. And remember, the goal is not simply to earn more interest. The goal is to keep more of it.